Hello everyone and welcome to the Rainey Review for June 2023. This slide shows the growth of wealth of $1 invested in various asset classes for the 3 months ended June 2023. The leader over this quarter is unhedged international shares in Navy, where $1 invested 3 months ago would have grown to $1.09. Jostling for second place this quarter are New Zealand property in black and emerging market shares in red, which both would have grown to $1.03. In the middle of an unambiguously positive pack is a 50-50 mix of shares in property and cash and fixed interest, which would have grown to $1.02. Not a bad start. This slide shows the same asset classes, this time invested over 12 months. The leader, again, in Navy is unhedged international shares, where $1 invested 12 months ago would have grown to $1.20. In second, this time, is Australian shares in Australian gold, where $1 invested a year ago would have grown to $1.12. Middle of the pack is that 50-50 mix of shares in property and cash and fixed interest, which would have grown to $1.05. Not bad, considering this 12 months includes 6 months of a very difficult 2022. 1 year is interesting, but I always say we need at least 3 years' data. This slide shows the growth of these same asset classes, this time invested over 3 years. The leader, 3 times in a row this quarter, is unhedged international shares in Navy, where $1 invested 3 years ago would have grown to $1.48. In second, in Australian gold, is Australian shares, where $1 invested 3 years ago would have grown to $1.39. In third place, in orange, is global infrastructure, where $1 invested 3 years ago would have grown to $1.29. Middle of the pack, again, is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 3 years ago would have grown to $1.13. This June, the finance world mourned the passing of a rather unlikely giant, Harry Markowitz. He passed away in June, aged 95. No tragedy, of course, but a death that merited an obituary in the New York Times. The son of a greengrocer, Harry Markowitz earned his PhD from the University of Chicago for his 1952 PhD dissertation on portfolio selection. This groundbreaking piece of work led to the formation and universal adoption of modern portfolio theory, for which he won the Nobel Prize in Economics in 1990. Well recognised in the finance and economics fields at least. He was named Man of the Century by investment publication Pensions and Investments in 1999. So what did he actually do? Markowitz was the first academic to not only identify that risk matters, but document and verify it. This changed the way the world thought about investing. Up until this time, investors thought that individual investments had different expected returns. Essentially, pre-Markowitz, investors picked the best investments and allocated all of their money to them. Markowitz's research proved that individual assets in the same asset class had the same expected return. This led to the development of the efficient frontier, where all optimal combinations of investments or portfolios lie. The conclusion is that by diversifying and holding combinations of investments, we can not only decrease risk but increase expected return. This marked the emergence of risk as a key consideration in investment decision making. It is not exaggerating to say that this marked a paradigm shift in investment management. Here's a worked example of Markowitz's findings. On the Y, or vertical axis, is risk, as measured by standard deviation, something Markowitz had to do by longhand, by the way. This measures the amount that returns vary. On the X, or horizontal axis, we measure the number of shares. Up the top, we have one share with an expected return of 10% and standard deviation, or risk, of 50%. That seems like a lot. What if we add another share? The expected return doesn't change, but the risk comes down quite a lot. What if we add yet another share? Again, the expected return does not change, but the risk comes down substantially. What if we own the whole market? The expected return, again, does not change, but the risk, as measured by standard deviation, is a fraction of what we experience holding just one share. That's diversification in action. So, remember the greengrocer's son's key message: stay diversified and stay invested. Thank you all for watching. I look forward to updating you again in the next instalment of the Rainey Review.